To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
Hi friends, let us now revise the next chapter in the unit of financing decisions, that is capital structure theories and decisions. Now in this chapter, as the very name says, there are two parts. The first part talks about capital structure theories and the second part talks about capital structure decisions. Let us now first move into the first part, that is capital structure theories. Capital structure theories. Now, as the very name suggests, what are we talking about? Capital structure theories. That is, the theories related to capital structure. Now, first of all, what is capital structure? As the very name suggests, capital structure is nothing but structure of a capital. Now, what do you mean by structure of a capital? It is nothing but a combination of sources of funds which form the capital. Various sources of capital together, combined together, will form the capital structure. Alright, therefore we know what is capital structure now. Now what is the capital structure theories we are talking about? The theories which are concerned to capital structure, the theories in short are related to the concept of relevance. That is, our capital structure theories are of two types. That is, one is called capital structure relevance theories and capital structure irrelevance theories. Capital structure relevance theories and capital structure irrelevance theories. Now friends, what relevance or irrelevance are we talking about? This word relevance is seen here. So the key word what we find here is relevance. What relevance are we talking about the capital structure? Now there has to be some other element which is talking about the relevance to capital structure. Yes, what is that element? That element conceptually is value of a firm. Meaning, in short, what we'll be learning in this chapter is, in evaluating a firm, will the capital structure be playing any role or not? In other words, can a capital structure influence the value of a firm? Now, is there a direct relationship between capital structure and value? Superficially, if you look at what is capital structure, equity, debt, preference like this, absolutely. Therefore, value is nothing but a combination of all these things. Okay, therefore, superficially when we see, we can say, yes, there is relevance. But technically, when you see, conceptually, there are two types of theories. One is saying capital structure is relevant in valuing a firm, but other theory says capital structure is irrelevant in valuing a firm. Now, how can we say whether it is relevant or not relevant? We should have some mathematical proof. Yes. For that, we cannot directly link between capital structure and value. We will also have to take the help of something called as cost of capital. We understood what is cost of capital in the previous chapter. What is cost of capital? Nothing but the overall cost of capital, the overall cost of all the funds in the form of capital is nothing but our cost of capital. Yes. Now the question arises like this. Can capital structure influence the cost of capital? Okay. So if that can influence the cost of capital, can that cost of capital influence the value of the firm? No. Is there any relationship between this cost of capital and value of the firm? Absolutely yes. There is definitely a relationship between cost of capital and value of the firm. How do we define that relationship? Friends, we knew how to compute interest basically. Say debt component into the cost of debt will give us the interest. Can we say therefore KD is nothing but interest by debt? Now what is interest? The inflow of the debt. Debt is the value of debt. Similarly, can we say KE is equal to what is earnings of KE? The earnings available to equity shareholders divided by the value of equity, we call it S. Therefore, can we also say KO is equal to, now what is the cost? We are talking about overall cost of capital. Therefore, we will talk about the overall earnings, that is EBIT, divided by nothing but value of the firm. Now, this is a mathematical equation. There is no doubt. From this, can we understand, can we therefore say KO is inversely proportionate to V, or value is inversely proportionate to KO. Now, what does this mean? If KO is higher, implies value of the firm will be lower. If KO is lower, implies value of the firm will be higher. This is absolutely mathematical. Therefore, we can clearly say, boss, depending on KO, value will change. If KO increases, value decreases. If KO decreases, value increases. There is definitely a relationship between KO and value. Now, therefore, the question comes, is there a relationship between capital structure and KO. If at all there is, if capital structure can influence in KO, then what happens? Correspondingly, the value of the firm will change. Therefore, between capital structure and value, now what comes into picture is cost of capital. Therefore, now conceptually speaking, what is that we are supposed to understand? Can capital structure influence in computation of overall cost of capital? If yes, what happens? Correspondingly, value will change. Now, as per the capital structure, if the KO does not change irrespective of any capital structure, then what happens? Even value of the firm will not change. Therefore, those theories according to which capital structure can influence KO and correspondingly influence the value will form under the category of capital structure relevance theories. And according to those theories, according to which irrespective of any capital structure, KO does not change, meaning value of the firm will not change, they will come under the category of capital structure irrelevance theories. Now, as we said, superficially we can see that there can be a change, but for us to understand the concept better, there are certain limitations and assumptions to be made, based on which we will see whether capital structure can influence KO and correspondingly value of the firm, and hence we will talk about the different theories, that is capital structure relevance theories and capital structure irrelevance theories. So firstly, before we get into the theories, let us list out what are the assumptions or limitations what we made to understand these theories. Firstly, a firm is a going on concern, that we anyways know, okay. Then there will not be any change in the total capital employed. Therefore, we will look at one fixed amount of total capital employed. Therefore, there will be a change in the internal components. Say for example, debt and equity. Say for example, this debt is 5 lakhs, equity is 5 lakhs, debt can be 8 lakhs, equity can be 2 lakhs, debt can be 3 lakhs, equity can be 7 lakhs. Like this, there will be a change in the individual values, but the total capital employed will be the same. Next, there is no preferential capital. Next, there is no taxes. Next, there are no losses, there are no taxes, there are no losses, there are no retained earnings. No, friends, what do you understand from no preferential capital, no retained earnings? We are majorly taking only two components, that is debt and equity into consideration. Then, there will not be any change in the business risk, that is the operating fixed cost will be same, and hence what happens? EBIT will remain constant. Then, there will not be any change in the investors' expectations, and lastly, KD is less than KE, that is cost of debt is less than cost of equity. This we anyways know. Cost of debt we know is definitely less than cost of equity because equity shareholders' expectation is higher, risk is higher, and hence KE is always higher. That's all. These are the list of assumptions. Now let us move to the theories. Capital structure relevance theories. Capital structure irrelevance theories. So, under the capital structure relevance series, we have net income approach, and here we have net operating income approach. Here we have traditional approach, and here we have M&M, Modigliani and Miller approach. Now, this Modigliani-Miller approach, when there are no taxes, then it comes under the category of irrelevance, but when taxes are considered, it will come under the category of relevance. Therefore, here also we will write M&M approach, he will write here in the bracket with tax, here without tax. So, these are the total set of theories what we will be understanding in this chapter. So, firstly, let us move to net income approach. Let us move into the net income approach. So, net income approach. Friends, we said this is under the category of capital structure relevance theories, meaning capital structure can influence the KO, correspondingly even value of the firm will change. Clear. Now, what does this theory say? According to this theory, KD and KE are constant. That is, cost of debt and cost of equity are constant. And we also know KD is less than KE, meaning debt is a cheaper cost compared to that of equity. That also we know. Now, how do we compute the overall cost of capital? It is nothing but weight of debt into cost of debt plus weight of equity into cost of equity. Now, in this equation, cost of debt and cost of equity are constant. Now friends, if you observe, if these two are constant, suppose in a capital structure, say for example some 10 lakhs ka capital structure which is purely equity. Now if I start inducing debt, that is, if the weight of the debt gradually increases, what happens? Mathematically if you see, because this cost is cheaper than this cost, if this weight increases, what happens? Now the cost is tilted towards the cheaper cost, and hence what happens? If more and more debt is induced, the overall cost of capital will decrease, because the weight of the cheaper cost is increasing. As a result, the overall cost of capital will decrease. Therefore, the theory says capital structure is relevant in computing KO. Therefore, what happens? Capital structure is relevant in valuing a firm is what is the conclusion. But for that to understand, can we take a small mathematical example? The same example of 10 lakhs, what we said? Okay, let us take debt and equity where let us say KD is some 10% and KE is some 20% for easy computation. We don't even need a calculator for this. The numbers are like this. Say total capital is 10 lakhs. Alright. Let us say first case will be 0 and 10. Now what will be KO is what we are supposed to compute. Second case will say 2 and 8, say some 3 and 7, then 6 and 4, then 9 and 1. Okay, we have about 5 cases. Okay. Now in the first case, when debt is 0 and equity is 10 lakhs, now what happens? Completely it is only cost of equity. Therefore KO will be 20%. Now if the debt is 2 lakhs and then equity is 8 lakhs. Now what happens to overall cost of capital? What is the total weight? 10 lakhs. So 2 by 10 is 0.2. 0.2 into 10 is 2 plus 0.8 into 20. 16 plus 2, 18%. Now if 3 and 7. So 3 by 10 is 0.3 into 10 is 3 plus 7.7 into 20 is 7 to 14 plus 3, 17%. Now in case 6 and 4 case, 0.6 into 10 that is 6 plus 0.4 into 20, 4 to 8 plus 6, 14%. Now the last case, 0.9 into 10 is 9 plus 0.1 into 20 is 2, so 11%. Now friends, see what happened here. We are increasing, what is happening here? We are increasing the debt here. As a result, what happened? The overall cost of capital has decreased. Why did this happen? Because the debt component is increasing and because debt is a cheaper cost. As a result, what happened? The overall cost of capital has decreased. Therefore, what does this theory say? Depending upon capital structure, the cost of capital, overall cost of capital will change and correspondingly the value of the firm also will change. So this is about the conceptual understanding of the first approach, net income approach. And why is it called net income approach? Friends, what is our target computation here? What are we here to compute? KO. So how do we compute KO? EBIT by V. Yes. From examination point of view, practically what happens? We are supposed to compute KO. The question will be asking us to compute what is KO, because you say it is changing as per net income approach. What will be the KO? So KO is EBIT by V. Now what is V? S plus D. Now we will also be given D, but we won't be given S. Then how do we find out S? The formula we know, EA ESH by KE. So it is actually the reverse order. From the given data, we'll have to find out S first. From that, we'll find out V, and from that, we'll find out KO. Now, where is the game starting? The game is starting from the help of EA ESH, which is otherwise called as net income, and hence this approach is called as net income approach, and hence this comes under the category of capital structure relevance theory. Let's now move to the next approach, that is net operating income approach. Net operating income approach. Now friends, we said this falls under the category of capital structure irrelevance theories. Now, what does this net operating income approach say? It says, irrespective of any capital structure, I repeat, irrespective of any capital structure, KO will not change. Now, if KO doesn't change, then value of the firm will not change. Therefore, what can we conclude now? Capital structure cannot influence the value of a firm. Capital structure is irrelevant in valuing a firm is the conclusion. Now, so this says KO remains constant. What is KO? Overall cost of capital, irrespective of capital structure. Therefore, capital structure is irrelevant in valuation of firm. This is what the statement says or the theory says. Now, how can we say KO remains constant? Why does KO remain constant is what we are supposed to understand now. Now, in the previous case what we have seen, friends, we said net income approach, we said as we are inducing more and more debt, as debt is a cheaper cost, because as the weight inclining towards debt, the overall cost of capital will decrease. Now, here what this theory says, boss, KD is constant, no worries, but this theory says KE is not constant, meaning as we induce more and more debt into the capital structure, we have seen the cases at 0, 2, 3, 6 like that. Now, the theory says as we induce more and more debt into the capital structure, now what happens is the fear of equity shareholders, whether will they be able to make any earnings or will the entire earnings will go only for addressing the debt. This fear of equity shareholders will increase, meaning what? The risk will increase. Now, can we say if the risk of equity shareholders has increased, the expected return also will increase? Absolutely. If the risk is increasing, the expected return will also increase. Now, what is increasing? KE is not constant. KE is increasing. Now, the theory says as the debt component increases in a capital structure, KE also increases. Now, increases by how much? It increases by so much so that the benefit of this cheaper cost of debt, whatever we are saying in the earlier case, now it is exactly offset. And finally, what happens is it is exactly offset in such a way that KO remains constant. I repeat, what happens as the more and more debt is induced in a capital structure, the KE, that is the fear or the risk of equity shareholders increases, that is KE increases, the expected increases. As a result, it increases by so much so that the benefit of cheaper cost of debt is exactly offset, and finally it is ensured that KO remains constant, and hence what happens? Hence we say this capital structure is irrelevant in valuing the firm. This is the theoretical conceptual fact. Now, coming to the practical part, this is the conceptual part. Coming to the practical part, what is that we are finding out here? In the previous case, we said what is that we are supposed to find out? KO is changing. Now, here what is changing? KE is changing. Therefore, from examination point of view, what is that we are supposed to find out is what is KE, boss? How much is it increasing to make that KO constant? Now, how do we find out KE? KE is nothing but ESH by S. Yes. Now, what is S? We know S plus D is equal to V, therefore S equal to V minus D. Yes, we know what is D. Then what is V? We said EBIT by KO is V. Absolutely. Now, again, the game starts in the examination from where? In computation of V first. Now, how do we compute this V? After we compute V, then we find out with the help of S, we will find out what is KE. Alright, now where is the game starting from? It is starting from EBIT. What is this EBIT? Nothing but net operating income. So, we call EBIT as operating income? Absolutely. Therefore, as the game is starting from this net operating income, this approach is called as net operating income approach, and this is categorized hence under the category of capital structure irrelevance theories. Let us now move to the next approach, that is traditional approach. Traditional approach. Friends, we said traditional approach comes under the category of capital structure relevance theories. Meaning what? Capital structure is relevant in evaluating a firm, or capital structure can influence the computation of cost of capital and hence correspondingly can also influence the value of the firm. Absolutely. Now, what is this traditional approach? Conceptually speaking, traditional approach is a combination of net income approach, net operating income approach, and a slight extension beyond these two. Therefore, we will have to understand traditional approach in three phases. For that to understand, let us first write down what is our KO conceptually, the same formula, weight of debt into cost of debt plus weight of equity into cost of equity. We know this. Now, we will categorize into three phases, phase 1, phase 2 and phase 3. The phase 1 is similar to that of net income approach. Now what happens in net income approach, friends? In net income approach we said KD and KE are constant. Therefore, as per net income approach, if the weight of the debt increases, overall cost of capital decreases. Yes. So as per phase 1, it is similar to net income approach, that is KD and KE are constant. Therefore, as debt increases implies KO decreases. Meaning, capital structure can influence the cost of capital and the value of the firm. Yes. Now, the second phase talks about KD is constant but KE changes, similar to net operating income approach. Now, KE changes by how much? It changes by so much so that the overall cost of capital remains to be constant. Therefore, in second case what happens? See, if the weight of the debt increases here, even KE increases and KO remains constant. This is the phase 2. So, here KD is constant and as debt increases, KE increases, ensuring KO is constant. So, it is the benefit of cheaper cost of debt is exactly offset by the increase in KE, is what we said, similar to net operating income approach. Yes. Now comes the third phase. Now, what happened in the second phase, friends? We said, the equity shareholders started feeling risky. They sensed a financial risk that whether the funds available, will they be able to address the debt and will they have any earnings at all? Now, this theory says, boss, as the debt is further increasing, not just equity shareholders, forget about them, even the debt providers also will feel that will there be a possibility of addressing the debt. Therefore, what is increasing? Now, in the third case, if the weight of the debt is increasing, KE is increasing, also KD is increasing. Now, KE is increasing, KD is increasing, therefore what happens? Obviously, KO also will increase. Therefore, the fear is not just for the equity shareholders, it is also for the debt providers. Therefore, as per this, what happens? As debt increases, KE anyways increases and KD also increases. Therefore, KO also increases. This is the third phase as per the traditional approach. Now, friends, you may ask, sir, there is something called as KO being constant, then still why are we calling it under the capital structure relevance series? Friends, this is just one phase. There are other two phases wherein you saw KO changes, whether it decreases or increases, end of the day KO is changing depending on capital structure, and hence we categorize traditional approach in the category of capital structure relevance theories. Now, if you look at these things, in the form of a graph, say for example, you are plotting debt here on the x-axis and this KD, KE and KO plotting here. Now, if I draw in three phases, say for example, I am drawing in three phases here, what happens is, in the case of KE, first it is constant, then it is gradually increasing, this is KE. Now, KD, it is constant here, it is constant here also, but later on it started increasing. What about KO? KO has initially decreased, then it became constant and then it started increasing. So, this is how the graph looks when you compute, when you plot for KD, KE and KO. So, KD seems to be constant for a while and then increasing. KE is constant initially, from second phase it is increasing. KO initially decreases, then it is constant and then it increases. So, this is about the concept of traditional approach. Now, friends, from the examination point of view, what do we have to learn or what do we have to do here? From examination point of view, our challenge will be to compute the optimal capital structure. Meaning, we will be given KD, we will be given KE, we will be given the weights. The question will ask us to compute what is the optimal capital structure as per traditional approach. Now, what is this optimal capital structure? It is that capital structure at which the KO is the least, is called as our optimal or optimum capital structure. So, with the values whatever we have, we will compute KO for all the cases, all the scenarios, and whichever scenario exhibits the least KO, that will call it as the optimum capital structure. So, this is about the traditional approach and hence this also falls under the category of capital structure relevance theories. Friends, let us now move to the next and last approach, that is Modigliani and Miller approach. In short, we call it as M&M approach. In the year 1958, Modigliani and Miller, they have also supported this capital structure irrelevance theories, which is in line with our net operating income approach, and they have made few propositions with regards to this concept. Now, before getting to the propositions, in addition to the existing assumptions, they have also made some further assumptions at the time of making the propositions. Now, what are those assumptions? That all capital markets are perfect, all information is freely available to the investors, and all investors are very rational, and also classification happens according to the business class or business risk, and then there is no transaction costs and taxes are not there. So, considering these additional assumptions, they have made few propositions for the firms belonging to the same business class or business risk, or when a firm converts itself from an unlevered structure to a levered structure, or in either of these two cases, they made few propositions. Now, what are those propositions? Let us see. Proposition 1. The first proposition says value of unlevered firm or unlevered structure will be equal to value of the levered firm or levered structure. As we said, they have taken in two different scenarios, that is comparing two firms belong to the same business risk, or when a firm from an unlevered structure, it becomes a levered structure. In such cases, or when comparing these two firms, the value of unlevered will be equal to the value of levered. Now, what is the value of unlevered firm? EBIT by KO. Now, this is nothing but KO of unlevered. We are talking about value of unlevered, KO of unlevered. Now, what is the EBIT in case of an unlevered firm? There is no debt component. Unlevered means what? There is no debt component. It is nothing but ESH. Now, what is the overall cost of capital of an unlevered firm? There is only equity, meaning cost of equity of unlevered firm. So, this formula can also be written like this. Now, what is the value of levered firm? S plus D. What is S? S is the equity component of the levered firm plus the debt component. Now, this is how we compute the value of unlevered and levered. Now, here friends, we said value of unlevered is equal to value of levered. Therefore, in levered structure, you have two components, not just equity, you also have debt. But we said value of levered is equal to value of unlevered. Meaning what? Meaning, say for example, if unlevered value is say 100 lakhs, then in the levered structure, the debt, say if it is 30 lakhs, equity will be 70 lakhs. Meaning, the equity has reduced from 100 lakhs to 70 lakhs. Now, why will this reduce? Because what is the formula of computing equity? ESH of levered by KE of levered. Now, the KE of levered structure is higher compared to the KE of unlevered structure. Now, if the denominator is increasing, what happens? Obviously, the value will decrease. So, he said KE of levered is greater than KE of unlevered. Now, the second proposition talks about the computation of this KE only. Now, it is more by how much? The proposition says KE of levered is equal to KE of unlevered plus a premium of unlevered minus the cost of debt in the ratio of debt equity. So, KE of levered structure is equal to KE of unlevered plus debt by equity into KE of unlevered minus the cost of debt. So, this is the formula for computation of KE of levered structure. So, here sometimes what happens instead of KEU, we can also write as KOL or KOU, because KOL and KOU are same. So, here we can alternately write this as KO simply plus debt by equity into KEU minus KD. Friends, do not get confused, this formula is nothing but a rearrangement of our basic computation of cost of capital, that is KO is equal to weight of debt into cost of debt plus weight of into cost of equity. If we rearrange that, we can arrive at this formula. This derivation we have done when we learned the concept, so let us not bother about it, but end of the day, this is the way how we can find out the cost of equity of levered structure or levered firm. Now, the last proposition. it says KO of levered is equal to KO of unlevered. No, we know that in the first statement itself we said value of unlevered is equal to value of levered. That means correspondingly, obviously KO of unlevered should be equal to KO of levered. Then why did he specifically say it as a proposition? Here they have mentioned this specifically because the intention of this mention is to communicate that capital structure is irrelevant in arriving at the cost of capital or value of the firm. Then what is relevant? It is the investment decision. It is the investment decision which influences the value of the firm, but not the capital structure. So the investment decision has to be such that the return generated has to be over and above the cost. What cost? This cost. So if the return is over and above this cost, then such an investment decision is said to be a wise decision, and such a decision will influence the value of the firm or the value of the structure, but it is not the capital structure which influences. So this is the idea behind all the three propositions. In the year 1963, after hearing lot of comments about tax not being considered in their theories, Modigliani and Miller, they have revised their propositions considering tax. Now the moment tax was considered, what happened was this capital structure irrelevance theory became relevance theory. Meaning they had to accept and agree and propose saying that the values of levered and unlevered will not be the same. In other words, how they have made the propositions, let us just see. M&M approach, this is with tax. The first proposition, they said value of levered firm is definitely greater than value of unlevered firm. Why? Because of the tax benefit. Now value of unlevered firm, how do we compute? EBIT by KO of the unlevered. Specifically I am writing unlevered because in the previous case whether levered or unlevered both KOs are the same, into 1 minus tax. Then what is value of levered? Whatever is value of unlevered plus debt into tax. Therefore, to the extent of tax benefit, the value of the levered firm will increase in addition to the value of unlevered firm. Now, this is about the computation of value of unlevered and levered. The second proposition, that is cost of equity of the levered firm or structure, earlier we have seen it is KEU plus debt by equity into KEU minus KD, just like here, same as tax is considered into 1 minus tax, that is all. Now the proposition 3, what happened? Proposition 3 said, see, if value of levered is greater than value of unlevered, means what? Overall cost of capital of levered is less than overall cost of capital of the unlevered structure. Why? Because of the tax benefit. Therefore, these are the modifications which were made by Modigliani and Miller post consideration of taxation. So, these are the key and the most important elements in this chapter, that is capital structure theories.